Chapter 1. Investing is really simple if you take the time to learn it. By definition, an investor is any person or firm that commits capital with the expectation of receiving financial returns. Investors rely on different financial instruments to earn a return rate and accomplish important financial objectives like building retirement savings, funding a college education, or merely accumulating additional wealth over time. An investor is an individual who takes calculated risks with hopes of financial return. An investment is usually an asset bought after careful research to generate an increased monetary return or appreciation in the future. In this summary, Benjamin Graham and Jason Zweig go deeper and offer more insight into investing. They introduce readers to two terms commonly used in the world of stock exchange trading: investment and speculation. An investment operation ensures the security of your invested capital and a promise of profit. Speculating is an operation that neither assures the security of your money nor your profit at the end of the investment period. Thus, an intelligent investor is involved in ventures that will yield a long-term reward, while a speculator is more interested in what they can get in the short term. You will understand these two categories of people subsequently. You will also see how to conduct proper research before putting your money out there. At the end of the summary, you will learn how to make the best choice when faced with multiple investment options. People who invest make money for themselves. People who speculate make money for their brokers. Benjamin Graham. Chapter 2. The intelligent investor is one who makes decisions based on ample research so as to not incur losses. Intelligent investors observe the company whose stocks they want to buy, study the history of gain and losses, and protect themselves from any losses before moving forward to invest. They have long-term goals and know better than to speculate, and that's why they invest in stable stock returns instead. Investing seems like the sensible thing to do for any individual seeking to build and sustain wealth, but the stock exchange giants, Wall Street, profits more from speculation. They do this by downplaying investing as a means of making wealth. The speculator is prone to making rash decisions and trying out tactics that have recently worked. But like gambling, the house always wins in the end. Gambling houses sell the allure of speculation because they have calibrated the odds to their favor. Unsuspecting, money-hungry individuals would dump their capitals and expect to cash out big only to be disappointed. Gamblers pray for luck. Intelligent investors take calculated risks. Investment is a sure thing. It works now and will work long after. The intelligent investor knows this and stays ahead of the market. But what happens when the market suffers a setback or an unforeseen glitch that makes it harder to profit? How does the intelligent investor deal with inflation? What is inflation and how does it affect the market? Inflation is an instance where the value of money drastically reduces, usually due to an increase in the printing of money or a large influx of cash into the market. This occurrence affects the market significantly because whatever shares you had bought would have reduced in value, and you have stocks with poor monetary value. How do you survive this as an investor? The obvious advice is to buy more stocks, invest more in shares since they are low value so that when the market heals, you will sell them at a higher monetary value. Chapter 3. The intelligent investor makes wise decisions to stay ahead of the curve. The advice to invest in bonds might be a sound and a sure way to evade the stock market's inconsistencies. But there are sides to it that might prompt you to show caution. If your only interest in investing in stocks is the cash profit, then you run the risk of losing it all. The intelligent investor should consider it as a passive option and not a principal obligation. They can invest in foreign bonds, offerings from countries outside the U.S., but this is if they are willing to take on much more risk than previously encountered. Bonds are an alternative investment option, but should be bought with caution to avoid any blowback. The average investor tells you to invest in every startup's initial public offering or IPO, but this is speculative and doesn't guarantee positive returns. Unless you can pick every startup that will become successful, you will lose so much money. The intelligent investor knows which IPOs to invest in and isn't plagued with the guilt of missing out on a successful startup that causes other investors to panic and support in the next big thing, leading to loss. Investors who make decisions without adequate research are almost always setting themselves up for failure. The usual practice is holding stocks and selling them when they become overpriced and find shelter in bonds until another dip in prices. But the intelligent investor knows this is an impractical plan because you cannot simply predict when the market will experience a drop or a rise. Benjamin Graham and Jason Zweig urge investors to diversify their portfolios. But as you seek to diversify, it is not advisable to indulge in foreign stocks because it would mean you were robbing yourself of the security offered by your country's currency. Did you know the S&P 500 gained 27% in 2009, a phenomenal year? Yet 66% of investors thought it fell that year, according to a survey by Franklin Templeton. Perception and reality can be miles apart. Chapter 4. Becoming an investor involves a lot of research and practice. There isn't any training or certificate that qualifies one to be an investor. The layman can become one with the right amount of research and guidance. The average individual who is interested in trading stocks and funds can do so without fear if they follow the advice given by Benjamin Graham and Jason Zweig. These are steps to follow if you want to become a successful investor. Firstly, when you pick a particular company to invest in its shares, look at their long-term goals, the plans they have for their future. Secondly, consider the quality of their management. If the company is centered around paying the owners or managers huge sums, you shouldn't invest there. If the company lacks financial strength, you'd be making a financial mistake from which you'd never recover quickly. Also, it would be best if you considered the company's dividends per fiscal year, and lastly, the current dividend report. If you need more specific considerations before investing, the following should suffice. Avoid companies with a total market value of less than $2 billion. Go for the companies whose current assets are twice their current liabilities. The companies must have expected stock earnings for at least 10 years. The companies must have consistently paid dividends for at least 20 years. There must be a minimum increase of at least 1/3 in per-share earnings in the past 10 years. The company's share price should not be more than 15 times the earnings of the past 3 years. The investment business requires only that you have a keen eye and a willingness to always learn. With these tools, the layman can navigate the uncertain waters of the stock market, and with the defensive investor's approach, make maximum profit and minimize risk. Invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Benjamin Graham. Chapter 5. The enterprising investor is an intelligent investor and a risk taker. There are two types of investors we'll discuss in this chapter: the enterprising investor and the layman or defensive investor. The standard guidelines for picking winning stocks won't cut it for the investor who isn't afraid to take big risks, the enterprising investor. They'd have to employ a new set of measures that engage this investor's level of activity. Unlike the defensive or layman investor, the enterprising investor is more involved in running their portfolio and actively monitoring the investments they make, periodically tweaking the setup. Investors are advised to make adjustments to their portfolio periodically. For the enterprising investor, the following are a few ways to secure the most profitable stock options. The first step is to practice. They can start with monitoring the market, picking out the winners, keeping tabs as though they were banking on them with actual money. Always go for the companies run by the owners, not the managers, because there is a higher chance they will do business for the general good of both them and their investors. You can always keep an eye on the yearly earnings. Don't let the business owners fool you. Let the business numbers do the talking. It is imperative to keep an eye out for the company's health and financial power. That way, you are sure of getting profit when you invest long-term. The enterprising investor can also get convertible bonds that can be converted into stocks and other securities. These kinds of securities offer the holders an option to diversify their portfolio and a shelter to hide under if either of the fund's prices dips and loses worth. These convertible stocks outperform regular stocks and are a reliable option for the enterprising investor who's not down for getting stuck with an underperforming stock option. It's like copying and surpassing the current market. But if the stock it is mirroring does poorly, it will do even worse. This multiplier effect is one disadvantage of owning a convertible bond. Chapter 6. The intelligent investor picks the best deal from the multitude of options. How do you know which stocks to buy? And what do you do when you are about to make a mistake? Well, Benjamin Graham and Jason Zweig carried out comparisons on similar yet different companies and identified why and how investors might be drawn towards investing in them. Investors can be moved to invest in a company's stocks because it appeals to their emotions. The company slogan or a catchy ad might evoke a pleasant feeling, or they might associate the company's values with a fond memory. This is a wrong move. Investors should never let sentiments form their reason to invest. Emotions are an investor's worst nightmare and can lead to a bad investment. There is a tendency for us as humans to claim to have found a pattern, a handle on the market because of a few lucky guesses. It is noteworthy that this is false and can be detrimental for investors. There is no perpetual gain. Public opinion can also form or influence individual opinion. Simply because a company is hailed as groundbreaking doesn't mean it is. A company isn't famous or in the media. A lot doesn't translate to poor returns. Do your research and don't be bullied by peer pressure into making a mistake. The intelligent investor must realize that even the analysts can be wrong, and they might be better off taking the words of the business owner or owners instead. Certain companies declare their inability to turn in profit now and have difficulty doing so in the future as well. Even the experts can be wrong. You can research the stocks by yourself. If you were to observe the market diligently, you would of course see the performers at first glance. But look closer. The numbers can lie, or at least mislead. The initial valuation of a company might not truly reflect its actual success, and it isn't an indicator that it will do well in the next 5 years. Go for the less glamorous companies that produce steady returns, even though they're not in billions, but they're on the rise, and they are undisturbed. Invest in the proverbial dark horse and not the shiny white horse. It just might be whitewashed. Conclusion. An investment might seem like a drag because its dividends usually take too long, but it sure beats dumping your money on any get-rich-quick scheme. The chances of getting a good return on speculation are 1,000,000 to 1, but with investment, your invested capital remains unchanged and your profit comes correct. To effectively hone your skills as an investor, you must approach it with attentiveness and an avid desire to learn and a willingness to take expert advice. The intelligent investor can be anyone. If you use your tools right, it can even be you. Investment isn't some magical act that requires special spells or equipment. It is also not reserved to only a select group of people. In today's fast-paced economy, investment is a key part of wealth creation, and every individual should consider owning stock. Whilst it may seem too complex a concept to wrap one's head around, investing is pretty easy if you are determined and committed to research and practice. A lot of current investors are stuck in one kind of problem or the other because they're mismanaging their portfolios. This is why you'll have someone with a packed portfolio but end up broke. You need to do your research extensively before making an investment in any stock. To avoid running at loss, ensure you are armed with ample data supporting your decision and not just feelings. Being an intelligent investor is far beyond simply investing or research. Simply put, it is the ability to pick out favorable stock, know when to invest and when to sell. Try this. If you haven't considered a viable retirement plan, then take a look at stocks and bonds you can invest in today. You can also research the shares offered by top brands and purchase the best fit for you.